Dariusz, very good to see you. Today, we are talking through a smart alternative to high yield bonds. Investing during periods of economic uncertainty often requires some very advanced strategies, especially when and if stocks and bonds are both down significantly, like we saw in 2022. Take a look at the performance of the 60/40 portfolio here. Ouch. So that's why today, Dariusz, we're talking about structured notes, which are issued by some of the largest banking institutions and are great complements to traditional stocks and bonds. Can you just start by explaining what is a structured note?
Well, a structured note is a combination of a bond and derivative, which is usually an option. And it's a very similar structure what other products do that insurance companies provide, like index annuities or other products like buffered ETFs. It's just a little bit different um, variation through investment banks, like
Hmm.
JP Morgan, Morgan Stanley, all those banks.
Hmm. And you said that you had been looking for bond alternatives for a while, even before this terrible
Yes.
performance of the 60/40 portfolio.
Yes, we are looking for. We were not big fans of traditional 60/40 allocation, which is 60% equity stocks and 40% bonds for a while, because I I always believed since many years back that it's just too much risk. The rates are too low, and they probably can't go lower anymore. And if the rates go higher, the values of the bonds were drop, and they did last year. So we were correct on this. So we were looking for alternatives a while back, and
Hmm.
structured notes are one of the options that we can use as an alternative to the
Right.
bonds.
And there are typically three kinds of structured notes. Let's walk through these real quick: principal protected, income notes, and growth notes. Can you explain what we're looking at here and the difference between the three, please?
I can give maybe a couple examples
Yeah.
how those work. A principal protection note is no risk, basically no risk um, uh, financial instrument, and usually it's for 1 or 2 years. The maturity is very short, and basically you get upside of some kind of index like S&P or Nasdaq up to a cap, let's say 12, 13% cap annually. So up to that point, you can make the gain if the market goes up. But if the market goes down, you're protected. You don't lose any money.
Hmm.
When the note matures, you get your money back.
Hmm. And as we move along the risk spectrum here, do you want to touch on yield and growth notes?
Well, these are my favorite, actually, structured notes, because they produce monthly income. And it's a very good alternatives to high yield bonds, because they pay um, substantially much higher interest, and they're the maturities are very short, usually 12 months or
Mm.
less. So very flexible, and they have some risks, but those risks are um, not that probable. But to understand those risks, you just have to talk to the advisor, and he will explain the risks. But the risk reward ratio is what's very attractive. That means there's some risk, but the reward for that risk is very attractive, much more than high yield bonds or regular bonds.
Right. Or even equities, as we see in
Sometimes,
this
yeah,
one.
yeah.
Yeah. So, who should be considering structured notes? Is this for our lazy money? Is it to add protection? Or is it to create income?
I think both three,
Okay.
because could be for lazy money. Some people keep just lazy money in the bank. Banks pay about 5% right now, annual rate of return. Structured notes usually pay from 9 to 11, actually, these days. So for people that need income, that produces monthly income. So we use this as one of the income strategies for people that need income, usually in retirement.
Hmm.
Um, so yeah.
Lots of scenarios. I
Yeah,
do want to point out, though, because I feel like a lot of people are going to be watching this saying, wow, this sounds really attractive. This is not a product that you can walk down the street to your local
yes,
bank and buy. You have access to these specific structured notes because you are backed by our team of investment experts at Brookstone Capital Management, which manages billions.
exactly. And they negotiate the
Right.
rates and the terms on behalf of the client. So our clients can get much better rates or just benefits from those notes because they're negotiated. Yeah, it's for the benefit of the client. You can't
Mhm.
just go to the retail bank and just get a note. This
Right.
doesn't work like that. It's got
Right.
to go to investment advisory company.
Right. So if somebody would like to talk to you more about some bond alternatives, structured notes, and how they can fit into their financial plan, what's the best way to reach you?
They can the best way is just call our office, call our number, and schedule an appointment, or could be a phone appointment, a Zoom appointment, or in-person appointment. In person usually is the best. If anybody's interested to talk to me about those subjects, just give us a call.
Great. Darius, thank you very much.
Thank you.